nothing stops this trade. And what I mean by it is that large fiscal deficits in the United States are going to continue for quite a while. We generally see there's some selling pressure from existing holders. There's buying pressure from ETFs and entities like MicroStrategy. Um, I think we're slowly building out of the space, is my expectation. So if people ask me, do I think it's more likely that Bitcoin breaks out of the space or breaks down from the space? I think it's much more likely that we break out to the upside from this base, whether it's later this year or whether it's 2025. I tend to think that we're going to break out of this.
Lyn begins by addressing Bitcoin's year-to-date performance, noting that while it has been strong, much of the growth occurred in the first quarter. This early surge, she argues, was fueled by ETF pulling forward demand. Elevated expectations led to an overbought market, followed by a consolidation phase. Despite this, Lyn is optimistic about Bitcoin breaking out from its current base, whether later this year or in 2025. She believes the asset remains bullish, even with temporary headwinds. A key metric Lyn uses to analyze Bitcoin's valuation is the market value versus realized value. This compares Bitcoin's market capitalization to the on-chain cost basis, reflecting the aggregate dollar value of coins based on the last time they moved.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think it's because the ETFs pulled forward demand. I think basically Bitcoin got overbought in March, effectively. And that pulled forward demand. People had very elevated expectations. If you look at like year-to-date returns, Bitcoin's been very strong, even though all of that growth happened between January and March, and it's been consolidating since then. We generally see there's some selling pressure from existing holders. There's buying pressure from ETFs and entities like MicroStrategy. I think we're slowly building out of the space, is my expectation. So if people ask me, do I think it's more likely that Bitcoin breaks out of the space or breaks down from the space? I think it's much more likely that we break out to the upside from this base, whether it's later this year or whether it's 2025. I tend to think that we're going to break out of this. But I think that, right now it's a bullish asset. It's just that some of that like artificial demand was pulled forward, and that's one of the biggest headwinds against it. But I think that we've kind of gotten to the point where we worked through that. We kind of worked through some of that accelerated expectations, kind of renormalized. And a key metric that I look at is market value versus realized value. And you can apply that to any asset if you have the data for it, which is to say the market cap compared to what is effectively the on-chain cost basis, or the aggregate dollar value of coins, not based on the last time they moved. And generally, whenever you get a high market value compared to that cost basis, you're more prone to corrections. Because some of that inflated value is not real yet. It's not really been actualized and traded around with high volumes at that price. And so even though Bitcoin is roughly priced how it was in 2021, the bullish case is that the cost basis is now much higher. I would argue kind of the floor of how people treat it is higher. So back then, even though the market cap got over $1 trillion in 2021, the on-chain cost basis was something like 350 billion. Whereas now at the current time, we have a similar market value, but the on-chain cost basis is something approaching 650 billion. So you have that less of like inflated multiple of market value to realized value. And then even in this current period since March, even in this consolidation, the on-chain cost basis has increased from something like 520 billion to like 640 plus billion. So I think the floor is kind of keeps elevating, is how I view it. So the short answer is I think that discrepancy is caused by ETFs pulling forward demand, and that I think that we're kind of in a consolidation until we eventually break out. nothing stops this train. And what I mean by it is that large fiscal deficits in the United States are going to continue for quite a while. They're above average, and there's very little probability of them being meaningfully reduced anytime in the near future. And this has a variety of macroeconomic and investing implications. Um, a lot of investors are very focused on the credit cycle or monetary policy. That's really been the guiding force for developed markets over the past 4 decades. But ever since about 2019, and then especially starting in 2020 with COVID, we've been in this higher nominal and percentage of GDP fiscal deficit framework, which has been surprising to a lot of investors because a lot of their tools or a lot of the things that they historically learned to focus on are actually kind of taking a back seat to the sheer amount of fiscal stimulus and pre-stimulus that's hit the economy on a quarterly basis. And the relevant thing for crypto assets is that basically, the denominator is kind of in a sustained debasement mode, which, to some extent, it always has been. Fiat currency is always weakening. But basically, when you're running these high of structural deficits, that background level of debasement is faster. And so my general argument, like the key thing that I've been focusing on in my investing is that we're in a hotter nominal GDP and a hotter nominal asset price environment than we would otherwise expect if we were running 3% of GDP deficits rather than 6 or 7% GDP deficits. And I think that investors of all types, whether it's TradFi or in this space, should be mindful of that fiscal impact in the economy because it's actually a lot more powerful than some of the monetary policy impacts that we historically see.
Lyn predicts that the next cycle will emphasize differentiation between projects solving real problems and those relying on speculation. She views this as a natural evolution where market forces reward utility and sustainability over fleeting excitement. Addressing the role of ETF, Lyn asserts their inevitability for any sufficiently large and liquid asset. ETFs serve as a bridge for institutional capital, providing regulatory and functional access to Bitcoin. She argues that concerns about ETF undermining Bitcoin's value are unfounded. Instead, their introduction signifies the asset's growing relevance.
Each of those cycles, one was a liquidity cycle. So I've done research showing that the whole space is pretty correlated with measures of global liquidity. So what they tend to have in common, like the 2017 cycle, even earlier cycles, but let's say the last two cycles, 2017 and 2021, they were positive liquidity cycles. But then also there were tech narratives in the space. So whether it's ICOs, DeFi, NFTs, each one had these kind of leading narratives that eventually kind of saturated itself. It kind of hit a peak period of speculation. And then eventually kind of subsided and was no longer the main character narrative. So I think whether or not we get a broader rally in the space will partially depend on whether there's a narrative that's similar in scale to those. And at the current time, I don't really see a narrative like that other than maybe real world assets, but that it's kind of inherently less speculative in a way. Obviously, people can speculate on which rails will win markets like that. And people can place their bets accordingly. And even, stable coins are a type of real world asset, essentially. It's kind of the original real world asset is taking $1 and putting it on the blockchain. And so I tend to be focused on those utility questions. And so I probably the people here would be better than me at speculating on the next, say, non-Bitcoin narrative in the broader space. But the thing I would bring from a macro perspective is to say that the monetary and fiscal environment is probably less supportive of speculation in this upcoming cycle, and that it's more differentiating between what is actually solving a problem versus what is not. First of all, it's inevitable. Any asset that gets sufficiently large and liquid is going to have ETFs for it. That's basically the fiat system's API for plugging into it. That's just how they plug in. And so if any asset can't handle ETFs being made for it, if that's a problem, then that asset was never really useful to begin with. That's a fairly low hurdle rate that an asset has to step over to be globally relevant. So on average, I view it as a net positive, because it basically just means that there were large pools of capital that wanted to be in, but didn't have a regulatory or functional way to get into the space earlier. And so you had to use inefficient proxies like Grayscale, where in addition to being prone to the price of the asset, you were also focused on is the premium going to turn into a discount, or how deep can the discount get? Can the discount ever be resolved with like redemptions of any sort? And that of course blew a lot of people up in the past cycle when people were leveraged based on that issue. So you could argue that if spot ETFs came earlier, the last cycle could have been less damaging for people in the space. And then there are pools of capital that, like, for example, they can't even buy like a Bitcoin ETF. They can only buy, like, there are large pools of capital that can only buy stocks, like companies, or can only buy bonds. Right now, the main entity filling that role is MicroStrategy. So if you're a stock, and if you run a stock fund and you happen to be bullish on either Bitcoin or the space, one of the only avenues they can express that view is either the miners or MicroStrategy. Currently, there's not that many ways for them to express bullishness on the rest of the space. There's not really like that companies that are heavily engaged. Maybe Coinbase is probably the best way they could express that. And then same for bonds. So MicroStrategy is, for example, issuing bonds, convertible bonds. So if you happen to be a bond investor that happens to like the space, that's one of the avenues that they can express it. And the high premium to NAV shows that there's a lot of built-up demand among institutions for these types of products. And so when we come back to the spot ETFs, basically there's pent-up demand for these assets, and now that's being met. And there's a centralizing force to some extent, but a lot of it is just rotation. So we've seen, for example, GBTC had over 600,000 coins. That a lot of that drained into the other ETFs. There's now more coins in total in the ETFs than there were in Grayscale, but not by a huge amount. It only went up by a few 100,000 coins, and the price increase associated with that was pretty large. And so, to the extent that you'd get another few 100,000 coins into these entities, it probably would come with pretty big price increases, and therefore it'd be harder for them to kind of capture a very big percentage of the market. So I'm not that concerned about it, even though it's something I'm monitoring. As for how it impacts different assets, I have a little bit more concerns around how large holdings of an asset will impact proof of stake networks versus proof of work networks. But that still remains to be seen. And then it's also possible that because the current regulatory environment doesn't allow staking yields in the ETFs, that could slow down the attractiveness of those products compared to if we get products where the staking yield can be part of the total return environment.
Lyn highlights the inefficiencies of earlier proxies, like Grayscale's Bitcoin Trust, which subjected investors to premium and discount dynamics. Spot ETF, she contends, mitigate these issues and broaden Bitcoin's appeal to institutional investors. She points to MicroStrategy as an example of how traditional investment vehicles have facilitated Bitcoin exposure, noting the demand for such products among stock and bond investors. While ETFs centralize some holdings, Lyn believes their overall impact will be positive, driving significant price increases as additional coins flow into these entities. She acknowledges potential concerns for proof-of-stake networks, but sees these as manageable challenges.
Please like and subscribe my channel.